So today we're going to be analyzing some different valuation models. All of them are based off of discounting, or DCF, which is the most popular one in finance. Just to be upfront, I do have a lot of experience in finance, but this is not financial advice. So the basic DCF equation is you want to discount your cash flow. You can use net income as well, but I prefer cash flow per share because that's the actual cash that's going to the shareholders. And you're going to want to divide it by 1 plus your required rate of return, which is usually either WACC, which we'll get into in a later video, or it's your risk-free rate, or just a rate that you want to discount by. So in my case, I use 12 because the average stock market return is 10 to 12%, so I want to have a little bit of a margin of safety on the stocks that I own. So I used either 12 or 13% as my required rate of return or discount rate. So you're going to want to add up all of your discounted free cash flows into your future, and then to that you also want to add in your terminal value, which a lot of people will use, once again, WACC for the required rate of return or the discount rate, but we're not going to use that in this video. So to get your terminal value, you're going to want to project out your free cash flow for 1 year more. So in my example that I'm going to show, we project out 5 years of free cash flow. So the first 5 years you would discount like this, and then the 5th year you would project out the 6 years free cash flow and plug it into this equation. And this growth rate is going to be really important, and we'll talk about that a little bit more when we dive into the model. So this is our actual model. It should be in the description. So basically our terminal growth rate, or this G, you want to have it at what you expect inflation to average out in the future. I find that to be the best approach. You can try other approaches. We will try one more approach over here in this blue model, but I usually like to do what my long-term expectation of inflation is. So the reason why I have 4% for Google is because Google is, of course, a high growth company, and I see a lot of growth in the future, and I think that its terminal growth rate will average above inflation. So that's why you see this at 4% and not 2 or 3%, which would be average inflation over that time. So the other main thing that I'm going to talk about for this model is your growth rate. In this particular Excel, a base growth rate would be 100%, so that would be free cash flow staying the same. It just makes it a little bit easier with these equations. So when I say 115%, it really means growth by 15%. The other assumption that you're going to plug in is your multiple, and that's for the valuation using multiple, which I'll go into. So first and foremost, the regular DCF formula, you are going to do, as we showed, add up all the discounted cash flows, which this does. It adds up all the discounted cash flows, and it's important that you raise the discount factor to the year. This is because money, the time value of money, basically. And so your terminal value is once again going to be this equation. However, we're not going to use WACC. We're going to use our discount rate, which in this case I use 13%, and I would highly recommend that you use a number over 7 or 8%. So we're going to do our terminal value right here with what I've highlighted, and then what you want to do is, because your terminal value is in future dollars, you want to discount that terminal value back to today to get today's value, and then you add these up and you get your value. Now, there are multiple different ways to do this terminal value calculation, and we're going to look at another way to do the terminal value calculation, and this we're going to look at a multiple. So this is why you plugged in a multiple over here. And so this part's going to be the same. The period value is going to be the same for all these models, and you can disregard this. So basically what we're going to do is we're going to get the free cash flow in year 5 in our end year, and we're going to multiply it by our selected multiple, whatever multiple we think it's going to be trading at. So I put 20 because Google, once again, it's a growth stock. I think it has a lot of growth in the future, so I would be confident assigning it a 20 multiple. Maybe it's a bit bullish. Maybe it should be 18. But either way, you're going to multiply the free cash flow in the end year by the multiple, and then you're going to divide it by your discount factor to get to today's dollars once again, and then you add those up to get your valuation. So these are just two different ways of doing DCF, one using a multiple and one using terminal growth. Now, with regards to which one's better, it depends on the company. If terminal growth, if it's like a food company or a defensive company, and terminal growth is fairly easy to predict, then maybe using the terminal growth model is better. For a company like Google, terminal growth is relatively hard to predict, so I prefer using the multiple. I think that the multiple is the safer of the two options for any stock, but once again, this is not financial advice. Do your own research and come to your own conclusions here on which one to use. So the last model that we're going to talk about here is one that only works for companies that are paying out dividends, because you need to get the payout ratio and the ROE, the return on equity. So this model is basically the same thing. However, we're deriving the growth differently. So this is the equation that we use. This is for a CFA prep class. And basically what we're going to do is we're going to multiply the payout ratio by ROE times the book value, and that will get us our expected cash flow basically for the next year. And then we're going to divide that by our discount rate minus this term, 1 minus k times ROE. And this is really to represent the fact that dividends will not be reinvested into the company. And so this is effectively a way to replace the growth rate for companies that are paying a dividend. So in this model, we can see we basically just plugged it into this equation. And I hope you guys enjoyed this short little valuation in Excel video. There will be different videos where we'll analyze different financial statement topics in the future. But I feel like this is a really good starter for people who are trying to figure out how to value stuff on their own. There's a lot of services that you can pay to get a valuation software, which I used to do, but in reality it might seem mystifying at first, but it's fairly simple math, and so you can just build it out in an Excel like mine, and I'm gonna give this away to free in the description so that all of you can tinker around and use it and not have to pay for some service to invest. Thank you very much. See you next time.